Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for your money, your investments, your financial and retirement future. We are always glad to be joined by Chris McIntire, president and founder of McIntire Retirement Services. Chris, welcome back. Always a pleasure. And I guess first of all, some new team members there at McIntire Retirement Services you're excited to have join the staff.
Yeah, absolutely. And I've got a radio face, but we brought in Jason and Michelle, and they have a much better video face, and we'll be adding them to, a lot of the videos and whatnot with some of your help there as well, Peter. And very excited, known them for a long time, went to school with Jason's brother, so 40-year relationship, and it's nice to have them on board with us, and we're looking to help grow the practice and help contribute to their success as well.
Yeah, a growing team there at McIntire Retirement Services. And Chris, you already serve proactive savers and investors across Northwestern Ohio, 3 separate office locations to make things very convenient. And of course, always the ability to meet virtually via Zoom or the ease and convenience of technology, or start with a phone call. But growing the team, going to increase the capacity to help more people to craft that plan to achieve their goals.
Yeah, looking forward to it, and our clients are welcoming them in as well.
Well, we do appreciate all of the time that you spend here, Chris. We'll look forward to meeting the new team members, getting to know them as well. But ladies and gentlemen, if you want to get to know the team, if you want to get your plan together, your game plan for retirement, the written plan that you can get there at McIntire Retirement Services, pick up the phone, give them a call, let them introduce themselves, ask any kind of financial questions that have been on your mind, address those concerns, and get a solid plan for retirement confidence. The Game Plan for Retirement. It is a complimentary service there at McIntire Retirement Services. 800-868-1194 is the number to call to get that process started, to start the conversation. 800-868-1194, 800-868-1194. You can also always go online, McIntyreRetirementServices.com. Lots of excellent resources there, a podcast and video library where you can find almost any topic that has been on your mind addressed, and hear Chris's take on things, or how there are proactive strategies to address many of retirement's modern risks and concerns. Again, the easiest way to get that conversation started, though, 800-868-1194, 800-868-1194. And Chris, on today's program, you wanted to talk about a specific differentiation, a very important distinction that unfortunately is getting overlooked a lot, but it is maybe one of the most vital components to building that retirement success, and that is understanding the difference between an income plan and an investment plan. Why is this distinction so important, and do you feel that unfortunately more often than not it is being overlooked?
Well, Peter, that's a great question. And the way I would describe this is, for those of us that are still saving for retirement and working, we are investing our money, putting money in every paycheck, so to speak. And, that investment philosophy of dollar cost averaging, I'm putting money in at regular intervals. So when the market dips, I buy more shares. When the market's up at a peak, I buy less shares. So it's a great win-win. Somebody else takes the money out of your account, puts it into your 401k automatically for you, and it just happens to be a great investment strategy for the long haul. The other side of that is when you go into retirement, you need income. Before, you were using your wages as your income and also as the seeds for your investment plan. In retirement, now you're only relying on what you've been able to save through that investment plan. And the investment plan isn't necessarily an income plan. And I think you and I have used the analogy, the definition of insanity is doing the same thing and expecting different results. So an investment plan that got you to retirement isn't going to be the income plan that takes you through retirement.
Yeah, a lot of doubt and worry, Chris, a lot of questions. The number one concern for retirees, am I going to run out of money? And if that concern is so prevalent, if that reality is a concern for you into the future, we really need to question whether continuing to do the same things that we've been told that so many others have done and yet still had that concern or unfortunately seen that occur, is that the best way to do things? If that is the number one concern, is the status quo really working that effectively?
Yeah, no question about it. And, you have to look at the economics. The people that retired 5 years ago couldn't walk into a bank and get a CD paying 5% interest or a multi-year guarantee annuity paying 5% interest. If you think about it, you could plop down $500,000 and live off of the interest, $25,000 a year. You can do that now. You couldn't do that 5 years ago. So you have to have the flexibility of altering your investment plan and, if you're or your income plan as well. So if you've got $1 million portfolio and you want to use that 4% rule that we've talked about, right? Pull 4% out of it every year, adjust it for inflation. Well, how are you generating that 4%? Are you using dividend stocks, bonds, real estate to help that are income generating vehicles? Or are you investing in Amazon stock and hoping that the price of it goes up? So removing the volatility of what stocks can do is paramount to your long-term financial success. And, I know we'll go through a couple of examples here, but, if you look at like 2008, when the stock market fell 37%, you don't want to be in the S&P 500 index fund with 100% of your money in retirement and a year later have 37% less money, plus pulling 4% of that money out. I mean, that is a plan that's not an investment. That's an investment plan, not an income plan. I think Peter's probably a good analogy there.
Yeah. And Chris, you're a fan of the investment plan. You help your clients to manage the market's wild swings, volatility, and to make their money work harder to help them make progress toward achieving their goals. That is part of the service there at McIntire Retirement Services. But is it fair to say that during our working career, as we are making those contributions that you talked about, that building that investment plan to support us in retirement, that the work itself is the income plan? That is the part of the plan that is essential. That supports our lifestyle confidence, and it in fact supports the investment plan. It is required for the investment plan's success and survival.
Yeah, no question about it. And yeah, we do like growth, obviously, because people still need to outpace inflation ideally. We do use a lot of dividend paying stocks in our portfolio construction because they're typically less volatile than the growth stocks. We use Amazon as an example. It's been an unbelievable rocket ship, especially this year. But last year it fell over 40% in value. So you have to have an income plan as part of your overall portfolio management, and your investment plan can also be in there as well. But as you hit retirement, income is going to be more of the priority than the growth of it. Look, I at least need to maintain my principal and spin income off of here so that we can meet our monthly budgetary needs, because not everybody's got a pension these days. So income planning, it's amazing how this has evolved over the last 20 years, because 20 years ago, so many more people had pensions and Social Security, and we were managing money that they weren't even planning to ever spend unless they went to a nursing home, for example. Today, it's, look, I've retired, I've got a big nest egg, but I don't have a pension, so I really need to use this money, and I'll worry about what I pass on to my kids a lot later down the road than what we used to have.
Yeah, this generation has done a great job saving and accumulating far more wealth in personal assets. We had the tool of the 401k for essentially our whole career, but the big difference is, Chris, that we are going to be living off of our personal savings and assets by and large to support and maintain the bulk of the retirement income that we need, whereas the previous generation, with the benefit of those pensions, a lot of their personal wealth and assets was simply discretionary. They could continue to afford to take the same investment approach with whatever wealth they had built and accumulated.
Yeah, no question about it. And, they had the taxes withheld from their pension payments, their Social Security payments. And nowadays, if somebody wants to buy a condominium and they need to pull $100,000 out of their IRA, well, right, we probably got to pull out 120,000 because we have to deal with the tax side of things. And that even works, on their basic income. If they've got $1 million and they're pulling and they need $40,000 out of that, we also have to pull out more money to pay the income taxes on that. So that 4% withdrawal rate might not include the taxes for many people listening today.
And Chris, ladies and gentlemen, if you didn't know, he is a self-proclaimed tax geek. He helps his clients to identify where there may be inefficiencies or potentially higher than necessary tax liabilities into and throughout retirement. In fact, last week's episode was on the 6 stealth taxes in retirement and how to plan strategically to minimize or avoid them. It's not what you make, it's what you keep. And being efficient with your taxes is as effective as shooting for higher returns, but typically with far less risk involved. And so that is a big part and component of the game plan for retirement. If you've built a large nest egg for yourself, congratulate yourself, pat yourself on the back. But if it is yet to be taxed, tax deferred, then tax planning proactively needs to be one of the major conversations about your long-term retirement planning and success. And that, again, is a large component of the game plan for retirement. If you would like to understand your tax liability and control that, minimize it, or in some cases, you can even eliminate portions of that tax liability with proactive planning. If you'd like to see those strategies, identify which ones are right for your situation to control that tax bill, pick up the phone, request the game plan for retirement planning review and strategy session with Chris and the team there at McIntire Retirement Services, 800-868-1194, 800-868-1194, 800-868-1194. Chris, you mentioned that definition of insanity, doing the same thing over and over, expecting different results. My brother calls that persistence, by the way, but it is generally accepted as the definition of insanity. However, in thinking about this big transition that we make from our working career to retirement and the approach that we've been told to take, I think it may be equally insane to do something that is completely different, in fact, the opposite behavior, and expect to be able to maintain the same results. In other words, contributing money during our working career, just fine. We have the benefit of the growth of the market. Distributing money, taking withdrawals, creating income in retirement, we should not expect the same results from the market. It's like if I go to the swimming pool and have my head above water, things are just fine. If I try to do the same thing below water, I'm going to have a different set of results and circumstances. And a lot of people have seen their account balances, especially withdrawals, with withdrawals included, their account balances are underwater after a few years in the market.
Yeah, buddy. And here's a great analogy is, most folks who have been investing for a long time, they look at their statement every month. And how am I doing? Did it go up? Did it go down? And then in retirement, if we're shifting to income, we're not really worried about the statement balance. We're worried about did the income that it generated meet the monthly withdrawal that we're getting? Because in dividend paying stocks, we have the dividends coming out, but the price of the stocks is going to fluctuate. Okay. But if the dividend rate's staying the same, then we don't really care what the price of the stock is, if that makes sense to you there. So as we invest money we're investing in growth stocks, okay, in trying to double our money in 10 years, as an example, we use that dollar cost averaging. So for those of you that have a 401k right now, and you were putting money in last year when the S&P 500 and the NASDAQ were down 20 to 30%, you're seeing those returns right now because of the money you put in last year when the market was down. If you've got an IRA that you hadn't been contributing to and it took a hit last year, it's not going to recover as fast as something you were putting money into last year. And so that's why the analogy here is, look, if you're invested very aggressively and you were dollar cost averaging in from a growth standpoint, that's wonderful. If you're taking money out on a monthly basis using that same investment strategy of aggressiveness, I think we call it dollar cost ravaging. So you really have to start eliminating the volatility and those big peak to trough drawdowns, if you will.
Yeah, in fact, Chris, you've got this fantastic chart. It is the story of $500,000, but with three different directions of money. One where we're contributing, one where we're just letting it sit and ride, and then one where we are taking distributions. Three very different stories of what the end results are on that $500,000 over a 20-year period from 2000 to 2020 is the example in the chart here.
Yeah, we've been using that for one shape or another for about 10 years or so, Peter. And it's just amazing that everybody thinks, hey, I listen to all the talking heads on CNBC and, they say I should be buying just the index funds and invest in the S&P 500 and I'm going to do fine. You're going to do fine until it loses 40% from peak to trough and you're pulling money out of it. So who wins the race, the tortoise or the hare? Well, sometimes it's a draw. It's just the ride that you got there was a lot less exciting. And, we had that other analogy of if you used a bond portfolio for income versus a stock portfolio for income, you may be better off in the bond portfolio because you don't have all that volatility.
Yeah, and another set of charts that you brought along, Chris, is showing what has really been the accepted forecast for retirement, the 4% rule. But you used two different indexes. We started in 1999 with $1 million. In one instance, we used the S&P, and in the other instance, we used the aggregate bond index. Now, why are these two results so different, Chris?
Yeah, it's because the bond index did not lose 40% in 2008 like the stock index would have done. So if you lost 40% on the stock side, you have to make 60% just to get back to where you were. And then if you're pulling money out of that, that's a very hard recovery. Where on the bond side, if the bond values fell 10, 15% like in 2022, those bonds are paying interest. The new bonds being issued are at higher interest rates. So, you just have to ride through that cycle. You do not have nearly that peak to trough drawdown. You eliminate volatility.
Absolutely. Well, again, ladies and gentlemen, if you would like to see these charts, if you would like to apply your situation, your scenario to these premises of how to create a lasting, durable, dependable income plan for retirement. And it's not about the lump sum. It is about the dependable income that you can rely on that is confidence and quality of life in retirement. If you would like to see how you can structure that plan to reduce or eliminate volatility and to also be able to identify this discretionary money that you have available for continued investment and growth. Both sides are important. Both sides are really necessary to a true, well-rounded and balanced confident retirement. So pick up the phone, get that plan put together, especially if you are in the midst of that transition or maybe 5 to 10 years out. These conversations now can really be enlightening on how to build for a more confident lifestyle, quality of life in retirement. It is the game plan for retirement, the written plan, the document that you get there at McIntire Retirement Services to get the process started, to get the conversation, to have the review and the strategy session of your investments and retirement accounts. Give a call, 800-868-1194. That's 800-868-1194. 800-868-1194. 800-868-1194. Yeah, Chris, the difference is stark here. I mean, with the S&P, first off, the average rate of return from 1999 through the end of 2019, we would think of that as a good period in the market. And we always have that perception that, the market averages 10 or 12%. The average rates of return are actually a far cry from that. Over that 20-year period, 6.48%. And I sort of question whether the next 10 to 20 years is going to be as good as the last 10 to 20 years have been. But if we expect 10 or 12 and we only get 6.5, we are a far cry from where we thought we would be. But the real shocker here is what happens to our $1 million balance over that time. Using the returns of the S&P, that $1 million with a 4% rule withdrawal rate adjusting each year for inflation, by the end of 2019, only $148,000 left. How confident are we moving into the next year or the next decade of retirement when we've seen our $1 million go to $150,000?
Yeah, and and your average investor is again, so concerned with what was the value of the account month on month. versus what was the income that that account paid out. And that's the value of dividends. It's the value of interest from bonds or CDs. And also, we haven't talked much about this today, is that's the value of having an annuity that can give you a lifetime income as well and take pressure off of your portfolio when the market does disappoint you. So for a more aggressive investor, the argument there is that you need an annuity more than a conservative investor, because just in case you lose 40% on your aggressive side, you could rely on your annuity for the income aspect of it.
Yeah, and then Chris, on the other side, to sort of solidify that point, we've got the aggregate bond index, far less volatile, but with a lower rate of return. This was the shocker here. Over that same 20-year period, the average rate of return with the aggregate bond side, 5.04%. So a average rate of return that is lower by 1.44%, but we end up with $943,000 as opposed to the $148,000, $795,000 more 20 years into retirement. Now that is going to lead to probably a great deal of confidence. 20 years in, and we've only burned through about $65,000 out of our million. We're probably feeling pretty good, and we've created income over all of those years.
Yep. And, while you were on the treadmill at the gym, you didn't even need to watch CNBC and the ticker tape or listen to all of those programs on, what hot stock to pick. All you needed to do was eliminate volatility, and it was that simple.
Yep. That is the key, ladies and gentlemen. The volatility was the difference. If we have our income plan produced the withdrawals, if they are coming from a source that is fluctuating, volatile, you have the risk of locking in losses during market declines, removing those dollars, removing a greater percentage of your remaining balance during losses, and those dollars never recover. That impacts the entire trajectory of your retirement. And so, I ask, Chris, when in my retirement am I going to be comfortable seeing half of my starting balance? Is it 10, 15, 20 years? Is there any point in my retirement when I am going to be comfortable seeing my account balance dwindle as such? Because we've only got a finite amount of money, and we still have an unknown amount of time we've got to make it last.
Yeah, no question about it. And, you were making a reference on people expect 10% return out of stock over the long haul. What is going to be the driver of that? I've got more money sitting in a money market account in a CD than I ever have at any point in my life. And I'm a stock guy, so that money is not in the stock market pushing prices up. It's actually out of the stock market because I'm getting very boring rates of return, no volatility, and just the promises. So we do a lot of that. The only thing that's going to drive the stock market is people spending money, buying stocks, pushing those prices up. And if you can get 5% into CD, how much less money flows into stocks because of that?
Chris, we hear a lot about average rates of return. And okay, so we hear that person is exceptional, that person is excellent, that person is average, right? Average is never great. But yet we rely on average rates of return for our investment expectations, when in fact average can be very, very deceiving. You've got another great example that you can make available for folks. We'll put it up on the screen for those watching on the podcast. But an average rate of return for a mutual fund, 3-year average return of 10%, and yet, Chris, we end that period of time with less money than we started. How is that possible?
Yeah, because of the volatility while you're pulling the money out of it. Again, those peak to trough drops. Look at 2000 to 2002, almost dang near 50% drop in the S&P 500. The NASDAQ was even worse than that. And try pulling money out of that when it's going down, regardless of what all the talking heads say is buy a cheap index fund. You have to eliminate volatility out of the portfolio as much as you have to worry about, what the rate of return is. What's the overall risk of that portfolio suffering a major drawdown while you're pulling money out of it? And how long does it take to recover to get back to where you were minus the withdrawals? It could be years.
And Chris, we had a rough 2022, but the market has actually had a great 2023, brought back a lot of the losses, a lot of the account balances. Is now the time? Do we need to maybe not look this gift horse in the mouth? Do we need to take this do-over opportunity and take account and really see if there are some things that we should do differently now before the next market downturn?
Well, and I think this year in 2023, the market has been driven by a very few number of stocks: the Amazon, Google, Apple, Facebook, Netflix. If you remove all of those companies out of the S&P 500, what's the average stock is up about 3% for the year. So we're hoping to get a broader base recovery. And we started to see that in the month of July. And hopefully that trend continues and, we get a soft landing. We don't go into a deep recession. But the size of Amazon and Apple and Google and Facebook anymore, if they have a great month, it can make the market look a lot, very distorted, because dividend stocks have been lagging behind the tech stocks. And that's typically going to be the story. But again, last year, your dividend stocks didn't lose 40% either.
Yeah. All cyclical, but there are different components of a well-rounded plan that serve different purposes, Chris, and we need to have the proper balance. And another factor of the current environment that we are in that you have talked about is that the rates for interest, for protecting principal, living off the interest, the rates for generating that retirement income. Now is a great time to look at that. Income is on sale right now.
Yeah, it certainly is. And building income portfolios has certainly gotten easier. It's taken pressure off of having to rely on the performance of stocks and dividends. We still love dividends, obviously, but now we can incorporate multi-year guarantee annuities, the fixed index annuity space. We can include CDs. We can include, nice multi-sector bond portfolios, things we haven't been able to use in more than a decade. So if there is a bright side to, a rapid increase in the interest rates, it's, the savings and the money market accounts have gotten much better.
Well, ladies and gentlemen, again, it is all part of the game plan for retirement. It is not just a hope. It is not just a wish. These are written goals. These are defined strategies to help you achieve them. That is the planning process there at McIntire Retirement Services, identifying risks, issues, and opportunities for your money and into your financial future. If you would like to get that written game plan for retirement, pick up the phone, give a call, 800-868-1194, the number to call, 800-868-1194, 800-868-1194. You can talk with Chris, ask any questions that have been on your mind, meet the rest of the team there at McIntire Retirement Services, and get your game plan for retirement put together. Chris, always appreciate you helping us to break down the complex financial world, making it a little easier to understand, but also applying that for proactive savers and investors to have more confidence in achieving their goals.
Yeah, my pleasure, buddy. Good to see you. Good to hope everybody enjoyed your show this weekend, and be safe out there. Thank you.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.